You finally found the perfect property, you submitted your application, and then the unthinkable happens. The bank says no. It's a frustrating moment, but a rejection from a major institutional lender doesn't mean you're unlendable. It usually just means you don't fit perfectly into their highly automated, low-risk algorithm. When conventional banking giants pass on a loan, it usually boils down to 3 primary roadblocks. We can call this the institutional sandbox. To get an automated approval, you need a FICO score over 670 to prove character, verifiable W-2 income to prove capacity, and a standard conforming property for collateral. If you hit all 3, you are in. But if your profile lands outside of just one of these circles, maybe your income is solid but your credit dipped, or the house needs work, the system flags it and you get rejected. This is where the alternative mortgage market comes in. When the traditional route closes, an entirely different set of pathways opens up. But there is a catch. Alternative lenders don't ignore risk. They price it differently. You're trading higher interest rates and fees for flexible underwriting that is tailored to your specific roadblock. Let's start with the first major roadblock, the income gap. You might have pristine credit and strong cash flow, but because you are self-employed or a gig worker, you simply lack the standard W-2s that traditional banks demand. If this fits your profile, the specific solution is the non-QM or non-qualified mortgage market. This table shows how alternative lenders evaluate risk. Non-QM lenders bypass traditional tax returns, evaluating your actual cash flow instead. To qualify, you provide 12 to 24 months of bank statements, allowing them to calculate income based on real deposits. This allows you to secure loan approval through alternative documentation programs, or even by converting your liquid wealth into a qualified income stream through asset depletion. The trade-off for this level of access is cost. Non-QM loans carry noticeably higher interest rates than prime conventional loans, and they might include non-standard terms like interest-only periods. Managing them requires strict financial discipline. The second major roadblock is the FICO floor. This hits borrowers who have suffered a credit drop in the past, but have since stabilized their finances and saved up a solid cash reserve. Your best pathway here is a portfolio lender. These are usually local community banks, credit unions, or community development financial institutions that keep the mortgages they originate in-house. Looking back at the matrix, portfolio lenders assume 100% of the risk themselves, so they write their own rules. Instead of obsessing over a strict credit score, they look at your overall character and local standing. To make this work, you need to bring a high down payment to the table and ideally establish a deep existing relationship with the institution. Doing this triggers a manual underwriting process. Instead of a computer spitting out a rejection, a human loan officer can manually override the system and approve your loan. Keep in mind, you will need a significant upfront cash buffer to offset the lender's risk. And because these are smaller institutions, they can be geographically restricted and harder to find. Our third roadblock isn't about you. It's the property itself. Structural deficiencies or a need to close extremely fast can disqualify a home from conventional financing. If you are an investor or buyer looking at a distressed property, your specialized tool is private capital, often called hard money. Hard money lenders care very little about your FICO score or your debt-to-income ratio. They focus almost entirely on the loan-to-value ratio and the raw equity in the property. You're using the collateral value of the real estate itself to secure rapid, asset-based funding. This allows you to completely bypass slow institutional regulations and secure the property immediately so you can begin rehabilitation. The trade-off here is extreme. These are short-term bridge solutions, typically 1 to 5 years, with massive capital costs and high fees. If you can't rehabilitate the asset and refinance quickly, you lose the property to the lender. Finally, we have to look at total systemic rejection. This is when a borrower simply cannot qualify for any institutional or standard alternative loan. When the banking system as a whole fails you, the ultimate bypass is seller financing, sometimes known as owner will carry. Here, you cut out the middleman entirely. You negotiate directly with a property owner who holds their home free and clear of an existing mortgage. You sign a promissory note directly with the seller, The seller acts as the bank, which completely bypasses FICO minimums, conventional appraisal rules, and standard income verification. The downside? This severely limits your property search. You can only buy from highly motivated sellers or specific real estate investors who are willing to take on the contract. And financially, these agreements almost always require a large balloon payment after a few years when the seller eventually wants to cash out. You will still need a plan to refinance down the road. Navigating the subprime market requires caution. While alternative loans can bridge the gap to wealth building, bad actors use these same tools to create perpetual cycles of debt. Predatory underwriting thrives on the power imbalance between a desperate borrower and an aggressive lender. If you are stepping outside the traditional banking system, you need to know the warning signs of a loan designed to fail. Watch out for these 4 tactics. Be wary of stated income loans, where lenders push you to declare an income without verifying it. This often leads to mathematically impossible monthly payments, setting you up for repeated loan flipping just to keep your head above water. Another trap is equity stripping. This happens when a lender intentionally loans you more than the property is worth. If the market dips even slightly, you are trapped underwater and cannot sell the house to pay off the debt. The ultimate rule of self-protection is this. Under the ability to repay rule, legitimate lenders must verify that you can actually afford the loan. If a lender uses these red flag tactics, they aren't offering a lifeline, they're setting a trap. Successfully navigating the alternative mortgage market means knowing exactly who you are as a borrower. If you have strong cash flow but non-standard tax returns, target the non-QM route. If you are rebuilding your credit but have cash saved, seek out a local portfolio lender or a community institution to build a human relationship. If you need rapid funding for a distressed property, utilize hard money, but only if you have a strict mathematical exit strategy in place. Getting a no from a traditional bank is not the end of your ownership journey. It just means you need a different financial tool. When the standard system locks you out, you have options. Make sure you strictly read the math and understand the trade-offs before you sign.